And let me throw a few things at you, because you and I would think during the course of our day, talk sometimes to similar people. In other words, people who are allocating capital for a living and making decisions. This is what I'm hearing this morning, at least from some. Real slowdown in some of the data. Is the Fed going to engineer what ends up being a hard landing? Mortgages above 5%. What is that going to mean? The lockdown in Shanghai, what does that mean overall? Is the economy slowing globally? Is the consumer slowing? Is the likelihood of a recession higher? I put it to you, Mr. Chief Equity Strategist at Goldman Sachs.
All right. Well, a number of those items are, in fact, a big topic of conversation with clients. Definitely recession risk, stagflation, and the higher rates. I would say those are sort of the top three commentaries that people press us on and try to understand. Our view at Goldman Sachs is that we are in a decelerating economic environment, but still unlikely to have a recession. And the yield curve is suggesting maybe 1 in 3 probability, 1/3 probability of a recession maybe in 2023. So we're still looking meaningfully out into the future, probably more than a year. And in fact, the history of a inverted yield curve suggests that when the yield curve inverts, there's often or typically a recession maybe 20 months into the future. So that's a pretty long time. I think the more immediate issue that people are sort of pivoting towards now is thinking about earnings season, which will kick off next week with the banks. And we'll get a whole series of individual idiosyncratic data points from companies in the next month. And I think what's notable about that is that the expectation is for around 5% earnings growth. But, David, if you remove energy, where energy companies are going to have some 250% growth in earnings, there's no earnings growth.
Right.
So that's one issue. And the second is margins and the margin compression. Broadly speaking, around maybe 9 basis points of compression and maybe 60 basis points of compression when you take out the energy sector. So that's sort of a big issue.
And the compression is from what? Wages and or just everything in the supply chain?
Wages, commodity prices, supply chains, still some disruption. And those are some issues that will be weighing on I think, investors will focus on that.
So, David, if you're correct in your assumptions in terms of a recession is a ways away, if not, if ever, even with the deceleration, where does an investor want to be right now in terms of what they should be focused on that will hold its value, if not increase?
So the number one area has been on companies with resilient margins, and that's why the topic of margins is so pertinent. We want to think about the companies in terms of high and stable gross margins, and the idea over the last 5 years, that's before the pandemic, sort of during the pandemic, and then after the pandemic, where companies have been able to maintain those high and pretty stable margins. You can see Alphabet, Nike is an example, S&P Global is another example. These are companies where they have demonstrated prima facie evidence that they're able to maintain their margins through this challenging environment in the last 5 years.